Before we start, if you're new here, genuinely go back. Episode 1, Episode 2, Episode 3, in that order. Because today we're building on everything we've already laid down, and jumping in cold will cost you.
Here's where we've been. Episode 1, two dads, two mindsets, same starting point, completely different financial lives. The difference wasn't income, it was how they thought about money.
Episode 2, the rat race, that invisible cycle where your salary grows, your lifestyle grows faster, debt quietly accumulates, and one day you realize you can't afford to leave the job that's slowly exhausting you.
Episode 3, the single most important financial distinction in this entire book. Assets put money into your pocket. Liabilities take money out. And most people spend their lives acquiring liabilities they genuinely believe are assets.
House, car, credit card balance, all pulling money away every single month.
And we ended episode 3 with a question. Okay, I understand the difference now, so what do I actually do about it? How do I start building an asset column when my entire paycheck is already spoken for?
Today, that's exactly what we answer.
Welcome back to Cash Talk Podcast. I'm Sara.
And I'm Ali. Let's get into it.
So Kiyosaki opens this chapter with something that sounds almost rude. He says most people spend their whole career minding someone else's business.
And when you first read that, you think, okay, that's a bit harsh.
But then he explains it, and you realize he's not being insulting. He's being precise.
When you work a job, what are you actually doing? You're showing up every day, spending your energy, your focus, your best hours to build someone else's asset column.
The company profits, the shareholders profit, the owner profits, and you get a salary, which, as we learned in episode 2, gets absorbed by your liabilities before you even feel it.
So Kiyosaki's point is at some point you have to start minding your own business, building your own asset column, even if it's small. Even if it starts on the side while you still have the job.
And this is the part people misunderstand. He's not saying quit your job tomorrow. He's not saying become an entrepreneur overnight. He's saying your job is not your business. Your income is your asset column. And those are two completely different things.
That distinction is small in words, it's enormous in practice. All right, let's define what we need for today.
First term, your business.
In Kiyosaki's language, your business is not your job title. Your business is your asset column. Everything you own that generates income or grows in value independently of your daily labor. That is your real business, regardless of whether you have employees or a company name.
Second, self-employment trap. This one surprises people because we tend to think of self-employed people as free. They work for themselves, right?
But Kiyosaki makes a sharp distinction. There's a difference between being self-employed and owning a true business. A self-employed person, a freelancer, a solo consultant, a one-person operation, they still trade time for money. If they stop working, income stops.
That's still the rat race, just without a boss. A true business, in Kiyosaki's definition, can run without you. It generates income whether you show up or not, which is a much higher bar, but it's the right target. Third term, passive income.
Passive income is money that comes in without requiring your active daily effort. Rent from a property, dividends from stocks, royalties from something you created, a business system that runs on its own.
It's called passive, but building it is anything but passive. It takes real work up front. The passive part comes later.
Think of it like planting a tree. The planting is work. The shade comes later whether you're standing there or not.
I like that.
Fourth, scalability.
Scalability means the ability to grow without proportionately increasing your effort. A salary is not scalable. To double your income, you roughly need to double your hours. An asset can be scalable. One rental property can become 2, then 5, without you working 5 times harder.
Your effort stays roughly the same. The output grows.
That asymmetry, more output without proportionately more effort, is what makes assets fundamentally different from labor income.
Okay, let's build this out carefully, because I think there's a version of this idea that sounds like just start a side hustle, make extra money, grind harder.
And that's not what Kiyosaki is saying.
Not at all. He's saying something more structural. He's saying, look at where your attention and your money go. Most people spend both entirely on their job and their lifestyle, nothing left over to build something of their own.
So, minding your own business starts with a reallocation, not of effort necessarily, but of intention.
Where is the next dollar going? Into something that will generate more dollars or into something that will just cost you more dollars?
Rich Dad used to tell Kiyosaki, keep your expenses low, keep your liabilities low, and consistently put any extra money into assets.
Not into a bigger apartment, not into a newer car, into things that pay you.
And he was disciplined about this for years before the results became obvious.
Which is the part people struggle with, because assets don't always feel exciting in the beginning. A stock dividend isn't as satisfying as a new car. A small rental income isn't as visually impressive as a nice apartment.
But one of those things is building a future, and one is consuming it.
One is building a future, and one is consuming it.
Now, and I want to be really clear about this, Kiyosaki is not anti-job. People sometimes read this book and think he's telling everyone to quit and become an investor immediately.
He's not. He's actually quite practical about this.
He says, keep the job, use the job. The job gives you a stable income, benefits, structure. Use it as a foundation, but don't confuse the foundation with the building.
The foundation is not the destination. The job funds your life while you slowly, intentionally build something that runs independently of your labor.
And the key word there is slowly. This is not a weekend transformation. Rich Dad built his wealth over decades. Kiyosaki himself spent years learning, making mistakes, trying things before the results compounded.
Which is why this mindset is hard, because we want the result now. We want the passive income this month, the asset column tomorrow.
But wealth built on understanding accumulates differently than money earned through panic.
It's quieter, more deliberate, and far more durable.
Okay, let's go a layer deeper here, because Kiyosaki actually distinguishes between 3 types of income, and understanding all 3 changes how you look at every dollar you earn.
First, ordinary income. This is what most people have. Salary, wages, freelance payments. You work, you get paid. Taxed at the highest rate in most systems, stops when you stop.
Second, portfolio income. This comes from paper assets, stocks, bonds, mutual funds. You buy ownership in something. If it grows in value and you sell, that's portfolio income, also called capital gains.
Generally taxed at a lower rate than ordinary income in most countries, which is one reason, Kiyosaki points out, the wealthy often pay a lower percentage in taxes than salaried workers even when they earn far more.
Which sounds unfair, and many people think it is, but Kiyosaki's point isn't political, it's informational. The tax code is structured a certain way. Understanding it is part of financial literacy.
Third, passive income. Rent, royalties, business distributions. Money that comes in regularly from something you built or own, also typically taxed more favorably than ordinary income.
And here's the pattern Rich Dad understood. The wealthy shift their income over time, from ordinary to portfolio to passive, from trading time for money toward owning things that generate money.
And the beautiful irony is, the more passive your income becomes, the more time you have to build more of it.
Momentum works in both directions. Poverty has momentum, so does wealth.
Poverty has momentum, so does wealth.
Which one are you feeding right now?
Sarah, I want to get honest for a second, because I think there's something this chapter glosses over that we should address.
Go ahead.
I want to get honest for a second, because I think there's something this chapter glosses over that we should address.
Go ahead.
Building an asset column is genuinely hard when you're starting from zero. When your entire paycheck goes to rent and food and basic survival, the idea of redirecting money into investments feels almost insulting.
That's a fair point, and it's real.
Kiyosaki writes from a perspective of someone who had mentorship, opportunities, and choices that not everyone has, and we should name that.
We should. At the same time, and I believe this, the thinking is accessible even when the capital isn't. You can start shifting how you see money before you have extra money to move.
The mindset shift is free, the financial shift follows.
And sometimes the mindset shift leads to small decisions that slowly create margin, cutting one liability, choosing not to upgrade when you could, putting $50 somewhere intentional instead of letting it disappear into the month.
It's not glamorous, but it's real, and it compounds.
Because $50 invested consistently over 20 years looks very different from $50 spent on something you don't remember buying,
Time is the most underrated financial asset most people have.
especially when they're young, and most people spend it without realizing its currency.
All right, let's bring this home practically. A few questions worth sitting with this week.
First, what would happen to your income if you stopped working tomorrow? How long could you survive? A week? A month? A year?
That number, the gap between your income stopping and your lifestyle collapsing, that's your actual financial reality. Not your salary, not your title. That gap.
Second, do you have anything in your life right now that generates income without requiring your daily time? Anything at all?
If yes, how intentionally are you growing it? If no, what's the smallest possible first step towards changing that?
Third, and this is the big one, when you imagine your life 10 years from now, are you picturing a bigger salary or a different income structure?
Because those lead to completely different paths starting today.
One path keeps you inside the machine, the other starts building something outside it.
Both take effort. Only one of them builds something that eventually doesn't need you to keep showing up.
Let's lock in today's terms before we close.
Your business, not your job. Your asset column. Everything you own that generates income independently of your daily labor. That is your real business.
Self-employed trap. The mistake of thinking self-employed means free. If you stop working and income stops, you're still trading time for money, just without a boss.
Passive income. Money that comes in without requiring your active daily effort. Built through assets, property, equity, systems, intellectual property.
Scalability, the ability to grow output without proportionally growing effort. A salary is not scalable. A well-built asset can be.
And the phrase from today, your job is your income. Your business is your asset column. They are not the same thing.
Tattoo that somewhere.
At least write it down. So, 4 episodes in, we have the mindset. We understand the rat race, we know the difference between assets and liabilities, and now we understand what it actually means to build something of your own.
And there's one more layer, one that most people never even think about because it feels like it belongs to a different world entirely.
Taxes, corporations, and how the wealthy legally pay less while building more.
Episode 5, our final episode in this series, is where Kiyosaki pulls back the curtain on the financial structures the rich use that most people never learn about in school, never learn about at work, never learn about anywhere.
And it's not about loopholes or doing anything illegal, it's about understanding rules that have always existed but only benefit the people who know them.
Which, after this series, is going to include you.
Episode 5 is coming. Until then, one thing, just one. Write down one liability in your life you could reduce or eliminate this month.
One thing pulling money out of your pocket that isn't building anything.
Start there. The asset column gets built one decision at a time.
Drop a comment. What's one thing you own right now that actually puts money back into your pocket? Or what's one thing you want to build?
We read every comment, every single one. I'm Ali.
I'm Sarah.
This is Cash Talk Podcast. See you in episode 5.